Hi, I'm Tom Lydon here in Hollywood, Florida at the Inside ETF conference. I'm here with Jerome Schneider, Managing Director, Head of Short-Term Portfolio Management and Funding at PIMCO. Great seeing you, Jerome.
It's great to be here. Thanks very much, Tom.
A lot going on, but a lot's changed in the fixed income marketplace. So let's get to it. What do advisors need to be thinking about today?
Well, we're right now in an era of transitory turbulence. We have monetary policy, which is potentially reaching an end. We have a neutral rates that seem within grasp, at least for the U.S. economy. At the same time, there's a general veil of uncertainty with the markets. You have short-term rates which are higher than they've been almost in a decade.
Yeah.
At the same time, you have dividend yields in the S&P, which are actually through those short-term rates. So it's creating a lot of signals of uncertainty for investors who really want the best of all worlds. They want to seek safety, they want to seek returns, but want to do so in a low volatility way. And ultimately, one of the ways to think about that is what the value of fixed income is to portfolio constructs in that regard.
Yeah, so passive has gotten a lot of money on the fixed income side, but lately been hugely challenged. Talk about the case for active versus passive.
Well, you have to think about where in the cycle we are. And ultimately, where we are is a term of monetary policy where the Fed is going to continue to create a balance between risk on, risk off. Clearly, the motivation there has changed a little bit, focusing on financial conditions, maintaining a consistent level. But for investors, what that ultimately means is having a high conviction, and trying to have that high conviction is a little bit more uncertain in this environment because they don't necessarily know where the proximity is or where the end is, especially at this point in the economic cycle. So when you take into account that the uncertainty is continuing to percolate, ultimately just taking the beta, taking the index becomes a little bit more of a daunting task.
Yeah.
You want to be focusing on differentiating and taking credit risks, taking structural risks, and taking interest rate risks, which allow you to articulate and move and jostlate as actually opportunities expose themselves along the way, not just simply assuming the ride, which could be quite bumpy for the next few years.
Again, you and I have talked about this before. The Barclays Agg, the benchmark of the fixed income marketplace, is a lot riskier, lower quality, greater duration than it was 10 years ago. So are you seeing that slicing certain asset classes within fixed income and the portfolio construction built into those areas is an advantage, especially from your standpoint, portfolio management?
100%.
Okay.
Investors are going to be focused on not only return, but how they get that return, the volatility management component of that.
Yeah.
So from a credit perspective, you want to accentuate credit risks that you like and under-accentuate ones that you don't. From a structural perspective, you want to be thinking about how the liquidity is made up in the portfolio. Focusing on liquidity management not only as an offensive or not only as a defensive tool, how much cash you have in your pocket, but how do you utilize it on the offensive side. So products in the income space, products in the fixed income space should be focused on active management at this point in time to really create that better risk reward adjustment. Mint, low duration strategy we have called Elder, Bond have all done that very well over the past decade or so, but really this is the point in time in the cycle where investors really want to be focused on that precision of how portfolio construction actually happens and can ultimately help preserve that downside protection if things get a little bit rockier down the road.
Yeah, and I think your word precision is the key. Jerome, as always, great seeing you.
Thanks
Thank you.
very much, Tom.